Hi, everyone, and welcome to the Morton Brown live quarterly market update for this first quarter of 2026. I'm Katie Brown, and I have Dennis Morton and Cody Demmel with me this morning. Afternoon.
Hey. Afternoon. We're doing the afternoon this time.
We're doing a new time. Yes. We thought we'd check out the lunch hour and see how that goes for everybody. So once again, welcome. We are excited to have you join us. Here at Morton Brown, our vision is to positively impact the experience people have with money, relationships, and life. And this is one of the things that we bring forward to help bring our community together and share some education, provide a place where you can ask questions, and just happy to have you. So a couple of reminders for today. There is a chat box down in the bottom right-hand corner, depending on how you're plugging in today. Feel free to post questions, and we will do our best to either answer the questions as we're going, or if we get a number of questions, we might save them for the end. We have allotted today, we typically try to keep this to about 30 minutes, but we've saved a little extra time. So if we have extra questions, or we might go into I'm going to call it a bonus round of what's happened post the first quarter. So these last few weeks, how have things started to kick off in Q2 of 2026? So let's get rolling.
All right, everyone, let's get the chat box warmed up a little bit here. How are we feeling? Let us know in one word how you're feeling about the markets, investing right now. Give us a word that comes to mind. Fill it in the chat, and we'll share some of those in the group here as we go along. Katie, there's a lot to talk about here, but for reasons that might not be totally appreciated broadly, this was a fascinating first quarter. Just a lot of things to digest, and just felt like we were chasing any number of different stories all throughout the quarter.
Absolutely. I think there are various times where it felt a little chaotic. You're like, okay, this is the thing that's driving. No, wait a second. This is the thing that's driving. And just that chaos.
Yep. All right, so we're seeing cautiously optimistic, a couple other roller coaster. That's a good way of putting it. And you know what? We've done this. This is the 6th year that we've been doing these live market updates every quarter. And it does seem like pretty often the first quarter, it can be a choppy time. And I think we're going to take a couple minutes to talk about how to think about handling volatility personally, how to approach volatility, and how to become, I think the term that we've coined is a vigilant observer. How do you watch what's going on without feeling as though you need to commit? And I think the first thing that you have to do if you're going to weather times like we've had in the last couple of months in the markets is you have to be prepared before it gets there. Katie, we recorded a podcast last fall in November timeframe. And do you remember what the topic was then?
We've covered a number of different things. I know that we revisited the good old days. That was something that we was. Forward.
Yep. So when markets were at all-time highs, like what should you do, right? And I think that's the key. When you get to volatility, you can't start preparing when the markets start to fall apart, right?
Yeah, you really do have to put the work in ahead of time. And sometimes, I think sometimes that whole idea of things are good can be separated individually from what's happening in the markets also. So there could be some challenging volatility in the markets, but for an individual family or position, you might recognize, okay, things are pretty good with my family right now, employment, various things happening. And so the idea of the good old days, I think, can hit at various times. But the whole thought process is recognizing, all right, you're in a pretty stable position. Let's make the most of it. Put the work into the plan so that when that either personal stress or outside influences create stress, you're already grounded in the planning work and have a good, solid feeling for the future for yourself.
And we hear a lot about uncertainty. I've had clients ask me, how do you keep your head cool when there's so much uncertainty around? Well, uncertainty was part of the plan. If uncertainty isn't part of your plan, then you don't have a plan. Because we're going to have these events. We're going to talk through the data points of what the markets historically do, but we've contemplated that things might go sideways for a bit. And this is an area where we take our own medicine. We plan for our families, we plan for our business, we plan for our clients, and we're never planning for perfection. We can always have these months and quarters where things just don't go right.
Yes. Yeah, that's a good point. You want to be careful not to be too rigid with your plan, and
Right.
it really kind of staking down, this has to happen for that. There has to be flexibility in there, and there has to be an understanding of just the normalcy of life around us, which is never a smooth path.
And the other temptation, when you look at the number of things that we were confronting in the first quarter of this year: war in Iran, a surge in oil prices, the AI disruption of software companies, looming inflation, risks in private credit, K-shaped economy, you name it. You have to, yeah, that's a lot of stuff, all of it converging at one time. You have to have a strong filter. I encourage people to read more, watch less, long form content instead of short bullets. Really make yourself an observer and figure out, this is where your planning helps, what really matters to you. Because I guarantee you, many of those stories probably don't have relevance, or at least they're transitory in nature. And it's going to be just part of the noise that you have to filter out.
Or there's such a small piece of influence to the bigger picture. We often remind clients, you are not the market. A lot of times what you hear on the news is the S&P 500 did this, or the Dow, actually, that still drives a lot of news headlines as well. But none of our clients are 100% invested just in that. And so it's just that reminder too, that there can be little bits and pieces out there, but you are not zigging and zagging the same way that the news flow is.
And one last point on this, and Katie, you bring this up all the time, is that just because something happens does not mean you need to act, or worse yet, react to it. There might be an opportunity to adjust, but not necessarily react.
Agree. Yeah. All right. So let's invite Cody back here. And Cody, if you want to kick us off with some of the things that are, positive and negative happening around us right now.
Perfect. So as always, we want to take a high level balanced approach looking forward. So some of the areas that are positive so far through Q1 and going into Q2 of this year is value stocks have done very well so far year to date, especially in Q1 when growth stocks were selling off. The US economy remains strong and it continues to grow going forward. Inflation and unemployment remain pretty stable. Inflation has picked up a little bit here recently, but still over the last year, I think it's still up only 3.3%. And the US has grown to be more energy independent. And then some of the areas where we could be a little concerned going forward is obviously the war in Iran is still going on. There's been a lot of volatility there, both in the stock market. We'll go over how it, impacted bonds, and then obviously, the impact of oil. The Fed remains in a wait and see mode. So going into this year, the expectation was for around 2 to 3 interest rate cuts, but now there's maybe 1 or potentially 0 for the rest of this year. All the Mag 7s lagged the S&P 500 in the first quarter of this year. As Katie mentioned a little bit earlier, that has changed a little bit in April, but we're focusing on Q1 in this market update. And then with the uptick in inflation, with oil prices going up, bonds actually saw their prices drop a little bit because the 10-year treasury went up from around 3.9 to 4.3. So going forward, we'll toss it over to Katie to go over how the consumer is feeling.
Yeah, this is something that we pull forward on occasion. It looks like a very busy chart, but just to let you know what we're looking at here. So this is looking at the peaks and troughs of consumer sentiment going back to 1971. And then we're also highlighting, it also shares the S&P 500 returns 12 months after that peak or trough. And so, and we can see, going back to 1971, there has been a number of events, first of all, that have happened over that time period, but a lot of shifting in how consumers are feeling about the markets. And it's interesting to me because I often wonder, well, not often, but I wonder in this post-pandemic period, we have been really hanging out below this average line of consumer sentiment. Consumer sentiment's pretty low down here, March of 2026. But yet looking back, we've had very strong returns over the last handful of years. Versus if you look at a period back here, between the dot-com bubble and the great financial crisis, consumer sentiment was actually at a decent rate. And there could be different reasons for why that happens. But just acknowledging kind of where we're at right now is pretty low on the consumer sentiment chart, which honestly may not be a bad thing, because if we look at the 9 troughs of consumer sentiment, on average, the returns have been 24% going forward, versus when we're at the peaks, on average, the returns have been only 5, and just about 5%. So it's an interesting thing to watch, but I also kind of wonder, sometimes what some of those drivers are.
You know what, Katie, went back and forth on this chart a little bit, just trying to say, what is this telling us? Yeah. And I think one of the questions that we're often asked is, are we in a bubble? Is this a bubble in AI? Is it a bubble in private credit or private equity? Are bubbles here? And you look back to the 90s and the 2000s, and my point here, the 90s and the 2000s, those were bubbles. There's the dot-com bubble, there's the housing bubble. So people were feeling pretty euphoric, first about stocks and then about real estate. And so if you look at where sentiment is right now, people aren't feeling that euphoric about a lot, apparently. And that kind of markets like climbing the proverbial wall of worry. And this seems, and with you look at returns over the last few years, and it does seem like they're climbing that wall.
So anyway, just wanted to check in and see kind of how consumers are feeling. We always welcome that conversation too. If somebody is feeling, strongly one way or another, happy to have that conversation. But also recognize, so taking that into, bringing that to some of the economic indicators, once again, recognizing that consumers are feeling not that great right now, but I just want to kind of remind people, pull forward where we've been post-pandemic on some of these economic indicators. So we've had huge swings in GDP. Obviously, you pull in the pandemic, we dropped off that gross domestic product down 28%, but then we had a spike of 35%. Looking at things like unemployment, once again, the pandemic really spiking that unemployment, but then kind of normalizing and dropping down very low in 2023. Inflation, huge swings over the past few years. Obviously, we know that there's a lot happening right now related to the war in Iran, but there was a lot happening in 2020 and 2022 when it comes to oil and gas prices also. Does anybody remember when we were actually negative $37?
$37. So
yeah,
the oil's $140 off of its low at 130, at 103.
Yeah. But these are events that we lived through and survived through, and so now with higher gas prices, it's hard. I'm not going to dismiss that. Like it's harder to see that price higher at the gas pumps. But we've actually been higher recently as well. But if we look at other things like GDP growth and unemployment and inflation, right now, and I apologize, I didn't mention this, the yellow dot is where we are at as of the end of the first quarter. And these yellow dots for some of these economic indicators are actually in very normal to healthy places. So there's some good stuff happening around us as we weather some of the challenges that come as well. But this just tells us that we are resilient. Consumers are resilient.
Yep. So one of the other areas we'll jump into specifically on a component of inflation here. Talk about gas prices. And as again we were discussing this is one of the very few things that has a ticker symbol on it every single day. Like if you want to know what your stocks are worth, you're going to see the movement every single day. You know what it costs at the pump, you're going to drive past the Wawa every day and see how things are going up and going down. So you kind of have that, there's a psychological element to gas prices being an indicator of things being maybe not good or bad, but getting better, getting worse. What this chart shows us is gas prices going back to 1995, both in nominal terms, which is just what dollar amount you paid for it, but then also inflation adjusted terms. So as we know, $1 in 1995 is not worth $1 in 2026. So it adjusts for that difference. And what you can see is the trend here if you look at the inflation adjustment here, is that the highest point for oil prices was actually in 2012. On an inflation adjusted basis, excuse me, we're about $1.97 below that peak back then. Now, it feels higher because, again, the nominal trend has been higher recently. But we also think back, I mean, just looking at the time horizon of this chart, anybody who bought a house or a car in 1995, 2005, or even 2015, what's happened to those prices as they've gone up? So there's a lot of headline risk when it comes to gas prices, and some of that is kind of it's a recency bias that we see it a lot. But as a component of inflation, there are a lot of other reasons why people might be feeling either a wealth effect because of the way their assets have grown, or might not be feeling as good because of the prices they see that everything is costing that much more. And those things take time to come down. All right, let's jump over to global bond returns. We had a question in here talking about global bond returns. Cody, you want to talk about what's been happening in the bond market?
Yeah. So if we look at year to date, which is the dark blue line here, on the right side is corporate bonds, municipal bonds, and international bonds. And then on the left is US Treasuries. So the one on the right, if you look towards the bottom two, intermediate term bonds sold off the most year to date. Granted, that sell-off was only 0.6%. So, and we're going to go over the stock returns in a little bit, but stocks sold off 9% at their lowest point so far this year. Fixed income was only down 0.6%. If we look at the last year, so going back to the end of the first quarter last year to the end of the first quarter this year, the best performing bond was intermediate term corporates. That was up 6%. Intermediate term munis was up 4.5%. I think the most important thing to point out is over the last year, there was not one area inside of the bond market that was negative.
And we've talked about that repeatedly on these live market updates, is to say the best predictor of future bond returns is the yield to maturity from this point forward. And we've been looking at, 4, 5, 5.5% yield to maturities over the last couple of years. And that's what's been showing up. And a reminder that your bond fund, if you're invested in bonds, most of your performance is going to come from the interest that it pays you over the course of the year. So you might see slightly negative numbers, but you only have a quarter of the income that's paid out, and there's still 9 months left in the year.
Yep, exactly. This chart kind of goes over this. So if we look at the graphic on the left side, it does look pretty busy. So I will point you to just the light blue number, which is saying over the next year, if there is no change in interest rates, what should we expect from these different bond assets? So if we look at the intermediate term corporates, if there is no change, we should expect a little over a 5% return going forward. Municipal bonds, which are, just as a reminder, federal tax-free, 3.8%, and then all the different treasury bonds up top. The main reason we wanted to bring up this slide is, as we discussed a little bit earlier, the 10-year treasury went from 3.9 to at the high right around 4.4, which is almost a 0.5% move in the interest rates, and that's why we saw some of the sell-off in fixed income. So we weren't concerned when we had that sell-off. Yes, the volatility in the 10-year treasury of 0.5% in a month isn't exactly normal, especially when the Fed's not cutting interest rates or raising interest rates. But that's why, and also what Dennis just said, the most important aspect for bonds going forward is based on the starting yield. And we are still getting between 4 to 5% going forward on fixed income.
Can I point out something in this chart, though, too, that I think is really interesting? So we're focusing on the light blue because there is a possibility we may not have any additional rate cuts or hikes this year, and so pretty good stable returns. The dark blue and the gray, that represents if there is a cut in rate or fall in rates, I should say, of 1% or a rise of 1%. And I always think it's interesting to look at the 30-year treasury. If rates don't move, once again, the returns are going to be pretty steady. You're not picking up a whole lot of extra necessarily by going that far out if rates don't move. But if rates do move, you could see some significant swings in those longer dated bonds. And I know we sometimes talk about that as just kind of knowing what you're owning and expecting and like setting your expectations properly for how things could move, because you have, with those longer dated bonds, once again, you could have much larger swings almost stock-like movements versus what you might expect from a bond.
As wiser people have said, you're just not getting paid for that risk. You're not getting enough yield to compensate you for that. So why jump out there?
Yeah.
Very good point. All right, let's talk about and one more comment, and we can move on to global stocks. There was a question here about bond returns, about global bonds and the importance of having some combination of treasuries, corporates, international. I think it's important at times like this because there are policy responses from every central bank around the world. So the Federal Reserve and the Bank of Canada, the Bank of England, all the centralized banks, they're all responding to stimulus in different ways. And if you're going to try and capture, the global investable universe, you have to have some exposure to that, typically in a qualified account to shelter the yield. But having international bonds means you're capturing those different responses as they happen around the world. Mm-hmm. All right, let's jump over to the stock market. Okay, now we're going to talk about, and I think Katie alluded to it at the top of the show. When you turn on the evening news, what you see, and you don't get this story when you turn on the evening news. And here's what this is telling us. These are investable indexes, U.S. small value stocks, U.S. large growth, the total U.S. market, developed international, emerging markets, and small value stocks, international value stocks. If you look at the trailing 1-year returns, which is this light blue line here, the U.S. market is hovering around 18%, 18% for growth. But look at all of anything that's small or international is just clobbering U.S. large stocks now. That has not happened in a very long time. We talked about it last year that there was an inflection point. And what we're seeing now, especially fast forward into mid to late April as the markets have recovered, this trend is intact, that we're continuing to see small stocks outperform large, value outperform growth, and international outperform U.S. I don't know if we've been able to say that sentence for more than a quarter in a row in a long time, but it remains the case. You're seeing 30% returns in international small value stocks. And even to the downside, you look at the Q1 returns, as I said, large growth was down almost 10%. US stock market down 4%, but international, emerging, international small, US small were positive. So when a lot of the conversations that we have with clients in the first quarter, people were surprised that their portfolios were holding up as well as they were, because when they turned on the evening news, they heard about the NASDAQ and they heard about the S&P. But I think it's one of the things that advisors could be doing a better job. We see statements all the time. Most statements that we see are woefully underweight global equities. And it's really a help for performance. And it's not just what's going to perform up all the time. It's what's going to allow for diversification to stabilize things. And I'll show you that there's some really neat charts that are out there to show that point. All right, let's jump over to,
Talking about some stocks and stock returns.
Yeah, I know. And this is why we don't spend a lot of time talking about or investing in individual stocks, especially if you look at this chart. This is a chart of what used to be the Magnificent Seven and now could be dubbed the Hateful Eight, because what you're plotting here is on the x-axis, the year-to-date returns for the S&P 500. So here are the 8 stocks that make up the Hateful Eight. It's Oracle, it's Tesla, it's Meta, it's Google, it's Nvidia, and Apple, and Microsoft. All of them were negative in the first quarter of this year, some to an extreme level. And then you can see the rest of the 492 stocks in the S&P 500 all hovering around flat, some of them doing pretty well, but you can see the point contribution. Microsoft took almost a quarter of the downside. It accounts for about a quarter of the 4% decline in the first quarter of the year for the S&P 500. That's one stock doing that. And as you may know, these were the darlings for the last 4 or 5 years. And they're still up massively over where they were 4 or 5 years ago, but they've also had an outsized impact. So interestingly, you've seen other stocks take off. My favorite chart, and I can't remember which client it was, but I discovered this chart in the middle of a meeting earlier this year, is what's happening inside different sectors. So here's what we're looking at here. This is a chart. Think of Microsoft and ExxonMobil, 2 very different businesses, one heavily software exposed, one's getting oil out of the ground. Microsoft over the last year to date through the end of March, down over 20%. Exxon up over 30%. And this is the S&P 500 threading the needle right down the middle. This chart has held true since before the war, during the war, and all the way through April so far. There's this yawning gap. And people, and what it tells us is that there are certain sectors that are under attack from artificial intelligence, software being one of them. And that other blue line there is the software sector ETF. So Microsoft is a proxy for the software sector. People are selling those stocks and buying others. They don't seem to be selling stocks and going to cash. So there's this massive rotation that's happening in there. That's a really very interesting development.
I also think, especially looking at these last two slides, this is why it's very important to understand what you own and not just buying, a blank mutual fund. Knowing what's inside the mutual fund or ETF is always really important.
Yeah. One other stat, Katie, we were talking about this before. Liz Ann Saunders, the head market strategist for Schwab, she shared a statistic last week that said there's been, beneath the surface of this steadiness that's been in the S&P 500, at least at the top level, the S&P drawdown at the most this year was 9%. Peak to trough was down 9%. But the average member of the S&P 500 was down 19%. The NASDAQ drawdown was 13%, but the average drawdown for each member was 33%. So there's like bear markets happening in different sectors that if you're invested at the index level, you're not feeling all that pain, but it's happening inside there.
Yeah, that's fascinating. That's fascinating. And, speaking of drawdowns, you mentioned we had a 9% drawdown here. We found this chart from Ritholtz Wealth Management that we thought was really interesting. And it looks at various drawdowns, 10%, 20%, 30%, going back to 1950. And then it looks at, after that drawdown happens, what were on average the 1 year, 3 year, 5 year returns. But it also points out the win ratio. So when we've had a 10% drawdown in the markets, 83% of the time, the market was positive 1 year out. 3 years out, 93% of the time it was positive. 5 years out, 94% of the time it was positive. And we can see those numbers hold pretty true. And it's fascinating to look at the 20% drawdown, 99% of the time, 3 years out, the market is positive. And in this case, on average, 45% over that 3 year period. We see that drop off just a little bit when you get to the 5 year period. We're no longer at 100%. It drops off a little bit, and oftentimes it's because there's the next thing that's happening, and there's a reaction, and so it kind of becomes this cycle. But when we have these periods of drawdown, again, we always talk about there's opportunity in every market. So there are ways to be efficient as the market is selling off, but make sure to stay positioned so you catch that rise. Because if you miss just a couple of days in the market with those strong returns, you could cut your returns in half for the year or even longer. So it's just a really good reminder to stay disciplined. Obviously, make sure you have the right allocation in the first place. That's very important. But with your long-term money, stay disciplined. So, and to kind of take it a step further, I'm going to pull forward one of our other favorite charts that I absolutely love. This is looking at, once again, the S&P 500, this one going back to about 1980. So looking at about 46 years. I can do this math. 46 years. And the gray bar.
Okay, Katie, weren't you born right around here and you're trying to do the math on this?
That's the problem, because I did the math from when I was born. I was born 79. So I'm like, I'm turning 47 this year. Now everybody knows.
Live broadcasting the midlife crisis. Yeah. Okay, go ahead, back to you.
You had a crisis, not me.
That's right.
All right. So the gray bar shows each year's ending return of the S&P 500. So on any given year, you can see where the market ended. The red dot is showing during that year, at some point, there was a drawdown. And if we look over this history, on average, the market drops about 14% in any given year. So us landing here with a 9% drawdown that we experienced here in the first quarter, that's completely in the normal realm of market movements. Those influences are always different, but it's definitely within the normal realm of market movements. And it's interesting to note too that 75% of the time, the market still ends positive, even as we have some of those pullbacks. So, once again, just a good reminder to kind of zoom out a little bit and accept there's a bigger picture than just these short little nuggets of time.
Yep.
And Cody, maybe you can talk a little bit about some of the influences.
I was going to say, zooming out even further. So this chart goes back to 1970. And just to let you know what we're looking at here, it's saying if you invested $10,000 in 1970 in the S&P 500, what would it be at now? So that 10,000 grew to 3.5 million. Of course, this chart looks a little busy. So this chart just has a whole bunch of the different headlines that has happened over the last 56 years. There are some that's positive, some that's obviously negative, like the tech bubble here, the financial crisis here. One thing that I think is not funny, but crazy to look at, if you look at the COVID pandemic, that just looks like a little blip. But that was a 34% sell-off in the stock market. So again, zooming out, yes, there's going to be volatility in the short term, but you can obviously see what the trend line is, and it's up to the right.
One of the things that we were talking about when we looked at some of the events on here is, the number of companies that were around in 1970 and the reasons why they might not be around today. And it's not because of any of these events. Like it wasn't because, war broke out in the Middle East at some point, decades ago, and companies went out of business. It's because the markets changed, the economy evolved, and everything else. I think if we looked at the composition of, things like Sears Roebuck or American Tobacco, or there were just all these companies that were around in the 80s and 70s, Eastman Kodak, companies that just became no longer major contributors to the market indices. So there's a constant dynamism, and that's what gives us a lot to be optimistic about as investors, is that whether it's war or inflation or changes in consumer sentiment, you probably own thousands of companies that are trying to figure that situation out, that are trying to navigate that environment. Sometimes they're going to have their season in the sun, sometimes they're going to have a season in the desert. But the key is to have those different components, and it's usually not the headline that's going to be the most disruptive. It's an inability to adapt to new circumstances.
That's a good point. That's a good point. All right. So I think a lot of, anecdotally, a lot of what we talked about today is try not to get caught in the weeds and really focus on what matters. So, that financial planning, that flexibility, that is so important to continually build in that flexibility, which is honestly a process. Concentrating, understanding what your long-term goals are and what resources you have, earmarked for those goals, and letting them do their work so that you can reach those goals. And I know we talked a lot about discipline and making sure that you have that discipline approach in both good and bad markets, because you don't want to miss those couple of days of strong market returns because you got scared in the couple of days of rough market returns. Diversification, Dennis, I know you kind of hammered that home as well, talking about some of those equity returns and recognizing we're going to have periods of rotation, and you want to make sure that you're diversified. And that diversification also helps to reduce some of that volatility that you may receive along the way as well. And then we always talk too about costs and understanding the full costs of investing, which is not just the internal expenses or fees, but also taxes and how that contributes. So we welcome any conversations that will help, build that comfort level and that confidence for people to make sure that they can check these boxes and focus on the things that matter.
All right, I think that concludes the formal portion of this afternoon's programming. We're going to stick around because I'm going to show some crazy things that we've discovered about the stock market in the last couple of quarters. So feel free, those are our disclosures. Katie, we were talking about the streak, what's happened in April. So
oh my goodness,
the market was down like 4% at the end of the first quarter, and then everything changed. Everything got better, right, guys?
Nothing's changed really.
Nothing changed. But we did, I heard a fact on the radio last week that I could not believe, because the S&P 500 went up 13 consecutive days in a row. Uninterrupted positive days. That has never happened. That has happened one time since 1950. One time. And that was like 1971, where it had a 14-day streak. So that streak was broken, didn't get to 14. But whenever you say it's been 76 years since something's happened on a market that's open 5 days a week. That's wild, isn't it?
That's wild.
Yeah.
Yeah. Yeah. And it has been a very, very quick recovery here from all of the volatility that we had. Well, and I say all the volatility, I mean, it definitely was volatile. But Cody, you brought up a good point too, as far as, it didn't look like a regular V-shaped sell-off and then recovery. It was a different sort of sell-off. And if you want to touch on that.
Yeah, I mean, so the sell-off started in the middle of February and kept going till March. So yes, it was a 9% sell-off, but we bounced back 12% just in those 13 days that Dennis is talking about. So a 12% bounce back in 13 days is wild.
Yeah. But even the 9%, it was like little step, little step, little step, little step, and then so it's just interesting.
Another thing, and this was, I went back because this time last year we were having similar conversations related to the tariff tantrum and everything that was happening in April of last year. So I remember there was kind of a pessimistic tone to what we talked about last year. And guys, I found this chart that we put up in April of 2025. And what this shows is the average forward return for the S&P 500 after 4-day declines, consecutive 4-day declines. In the 1 year future returns, the average is 32%, 51% for 3 years, and over 100% over a 5-year period. So if you have 4 consecutive days. And what we noted last year was that we had 4 consecutive down days heading into what became the bottom on April 8th. So out of curiosity, remember, 32% 1-year returns. Out of curiosity, what is the S&P up from April 8th through April 7th of this year? 32% on the nose. We'd rather be lucky than good. But this is the kind of stuff we say, like when we talk about our expectations for the future should go up as volatility to the downside increases. It's counterintuitive sometimes, but when things are really good, we shouldn't expect them to stay that way. When things are feeling bad, that's usually when you get outperformance. So again, you had to be there for this, but there's the 32% number on the nose for the S&P 500 after that downturn last year.
Yeah, I think that also goes back to the chart that Katie went over, because the average S&P 500 return over the history is around 10% annually. If you look at these numbers, so after a 20% sell-off, 45% return in 3 years is 15% annually. After a 30% sell-off, 48%, so 16% annually. So yes, it never feels good when we're selling off, 10, 20, or definitely not 30%, but you have to look for opportunities going forward.
Yeah. And I think
to be clear, I mean, we don't make predictions necessarily on what the market's doing, but we very much pay attention to what has happened historically and can that inform how we think about things going forward. And there's a lot of great history out there.
Yes. And I think as investors, if you're thinking about your plan and trying to maintain calm and kind of even keel demeanor through all of this, it's that in the short term, anything can happen. That's that litter of events that Cody had on that last chart. Anything can happen in the short term. Over the long term, things start to look like the back of the baseball card, and you just start back to historical averages, which has been very true. I mean, this remains a very strong period for equity returns going back over the last 15 years.
Yeah. Something else I would say though, like if we only looked at that U.S. return over the past year and saw it was up 32%, which was extraordinary, it's incredible. It would be very easy for somebody to say, well, I should put everything in the U.S. stock market then because it was up 32%. But as we talked about, international emerging markets, international small caps, they actually outperformed the U.S. So that, once again, diversification. U.S. did very well, but there were other significant contributors to a holistic return last year.
Yeah, it really has been extraordinary. So, and one other thought, just because it was happening before the war kind of broke out on February 28th, but the disruption of artificial intelligence, what's happening in the stock market, we had effectively AI laser focused on the software industry, and you were getting just 30 and 40% declines in software names, many of which being very familiar to anyone here, Microsoft and Oracle and others. And I think what was happening was you were getting a major drawdown in certain sectors and what was being disrupted, but there were also sectors of the economy that were showing to be resilient and maybe non-disruptible. And think of like an ExxonMobil or UPS, or just Walmart would be another one, where it just said, is the thesis that AI is going to make them better businesses, not disrupt their business and make the stocks less valuable. So it was an interesting tension that was happening there.
Yeah, and I'm sure we're going to see more of that too. We are still in the very beginning stages of AI and figuring out the impact that it's going to have across companies and the workforce and all of that. A little too early to make all the guesses.
Yeah. So I think if we're going to wrap up with this, if there's any more questions, this is a great time to kind of assess how you're doing. Look in your portfolio to say, do I understand what I own? Are there things I need to check in on? Are things functioning the way that they should? Is diversification working the way that it should? If you have questions for us, feel free to reach out. We love the education portion of what we do, helping you to understand how you're invested and also make sense of the world around you.